Hi, welcome to October 2012. But let's talk about September first. September was a great month, not only because markets were up, and they were up mostly 2 to 3% across the board, but more importantly because some of the indicators that I saw that made me feel much more positive about things going forward. To start off, U.S. productivity was up in the first part of September by 2.2%. Productivity is a very important indicator of what's going to happen in the future. And when it's going up, the markets will often follow it up in future months. We finally saw a break in real estate sales. Both new sales and existing sales were up. And you've probably seen news stories about groundbreaking and ground moving and more houses being put up every day. A very good thing for our economy. Another thing we saw was more jobs being created. The jobless claims numbers were down, and job creation was up across the board. Oil, although it started out at a fairly steep breakneck pace, finally ended the year, actually ended the month down 2 to 3%. Another good sign. There were a couple of negative indicators in the month. One was that some regions saw manufacturing decline just a little bit. Now, it's not that big a deal in the U.S. economy about manufacturing. It is important, but the fact is that services make up 75% of the U.S. economy, and services continue to be very strong. Now, globally, however, manufacturing is more important to certain countries, and that being China, Japan, and we have seen some problems with the manufacturing in those regions, and that may be a problem in the future. Another big news story was that Moody's threatened to downgrade U.S. debt again if they don't see a resolution to the fiscal cliff. Now, I want to refer you to the previous video that we did a couple of weeks ago about the fiscal cliff. If you haven't watched that yet, and you get a chance, go ahead and turn to that next and learn a little bit about what's supposed to happen with the fiscal cliff on January 1st of 2013. And further, there were some big warnings from some big companies in the month. The biggest probably being from Federal Express, in that they saw global growth, global shipments going down, and that's a pretty big thing for that type of a company to say, and it indicates globally that things might not be as well as we might think. Intel announced a revenue shortfall and a profit lowering, and also most recently, actually this month, Hewlett-Packard indicated that they don't see improvement in their company production until 2014. So some negative spots as well. But the biggest news for the month was the stimulus programs that we saw announced across the globe. Perhaps as much as $1 trillion will be added to the economy through stimulus programs in the next few months. The ECB, the European Bank, indicated that they were opening their checkbook as far as buying bonds goes, and who knows how many billions will be spent bailing out Spain and Italy and some of the other European countries, but they have indicated an unlimited buying power as far as bonds go. The Bank of Japan indicated a $160 billion stimulus program, and China announced different types of stimulus, primarily in the infrastructure of the country. The biggest, however, and the most noted was probably the Federal Reserve announcing QE3, which is a $240 billion stimulus program which will occur over the next 6 months, very much directed at mortgage-backed securities. Now, the effect has been immediate on interest rates. Right now, we're seeing mortgage rates at rates we have not seen in decades. Today, you can get, with a good credit rating, you can get a 30-year mortgage as low as 3.25%. It's absolutely incredible. And it's bound to have a very stimulative effect on the U.S. economy. So what do we see in October? Well, October, as you know, is notorious for the crashes that occur. Not always, but remember October 7th, 1987, October 19th, 1989. And of course, we all remember 2008, when the whole economic system almost came apart in October. However, I see a lot more stability right now than I have seen in the past, and hence I'm much more positive about things going forward. I had warned in a previous video about the fiscal cliff, and certainly we're worried about that. On January 1st, 2013, if things are not done by Congress, programs could be cut and could kick in to put us back into a bit of a recession. But I believe that the extreme low interest rate situation that we're in right now may compensate for some of the problems that might arise out of the fiscal cliff. So let's look at this scenario. Perhaps not the full fiscal cliff, but a portion of it will occur, more likely. And what happens if our low interest rate environment can stimulate the economy enough to make up for the problems that that small drop of a fiscal cliff will cause? That's the scenario that I would propose to you, and so I'm more positive than I've been in a long time, and I think it's time that we go make some money, Ben.